Principles of Accounting 2, Chapter 8 example. In Chapter 8, we learned about budgeting. And so in this example, we're going to create a operating budget for a manufacturing company. So the first tab that we have here in our PowerPoint presentation is just a whole bunch of information about that manufacturing company. We have their March balance sheet for end of March, and then we're going to make a second quarter operations budget. And the second quarter is going to include April, May, and June. We're going to go through each one of these pieces of information as we start preparing the budget, which is on the second tab of your Excel file. So as we need different information for the budgets, we'll come back and forth to get that information from this file. If you remember from the PowerPoint lecture about Chapter 8 or from your textbook reading, all budgets start with a sales budget. So we always start with our sales forecast and create every budget from that information. So we have different numbers for the sales forecast. So what we need are the April, May, and June forecasted sales and the selling price per unit. So we can find in this information how much we plan to sell in each month, April, May, and June, and that our selling price per unit is $23.85. So we'll go over to the budget information and we'll put that information into our sales budget. So we had 20,500 units in April, 19,500 units in May, and 20,000 units in June. Then our budgeted sales price was $23.85. And you'll want to formulate that cell to a dollar signs so that you get the full $23.85 because Excel automatically wants to make that $24. We then, in order to get our budgeted total sales dollars, take the total number of budgeted units times the sales price per unit. Because that formula is the same for all three, we can take this corner and copy that formula down. We then want our total number of units for the quarter. We'll add these three lines together and we have 60,000 total units. We don't want that to be a dollar. And we add these three together and we get our total budgeted sales for the quarter. And that is the sales budget. From the sales budget, we move to the production budget. Once we know what our projected sales are, we can plan how many items we need to manufacture each month in order to meet those sales. So we need to know some various things about, one, our sales. So we just pull that information down from our sales budget. It's very important to get into the practice of using formulas to fill your cells instead of typing in information. And one of those reasons is that when we make changes to this budget, if I change the number of units sold or the budgeted unit price, it will change every piece of information within the budget if I've created the formulas. And if I haven't created the formulas, then I need to go through and manually change all of that information. And one of the reasons we use Excel and learn to use Excel is to have Excel be the tool that does the math for us so that we can do analysis and not have to keep rebuilding the tool. So what we need to know is our ratio of inventory to future sales. What that ratio of inventory to future sales policy tells us is how much finished goods stock we want to have on hand as a buffer for the next month. This can also be called safety stock. How much stock do we want to have at the end of the month? We're going to go back to our information and we read C here. Company policy calls for a given month's ending finished goods inventory to be equal to 80% of the next month's expected sales. On March 31st, our finished goods inventory is 16,400 units. Okay, so our ratio is 80% or 0.8. And we can leave that as 0.8 or we can change it to 80%. We take, we actually want next month's sales. And in July, our sales are 20,500. So in April, we want our ending April inventory to actually be 80% of May's sales. So we take May's sales times our 80%, and I hit just one extra key there. There we go. Then we add this month's budgeted sales. So what we plan to sell in April, what we plan to sell in May, and what we plan to sell in June. We add our budgeted ending inventory plus our budgeted sales for the month, and that tells us how many units we need both to meet our sales for the month and to meet our budgeted ending inventory goals. Then we are going to deduct the beginning inventory. So remember that our information said on March 31st, we have 16,400 units in ending finished goods. That means our April 1st inventory is 16,400 units. For May, we need our ending inventory for April becomes our beginning inventory for May. So our ending inventory from April is beginning for May, and our ending inventory for May is our beginning for June. We take the units we need minus our beginning inventory, and that tells us how many units we need to produce each month in order to meet our goals. From the production budget, we use this information to build our raw materials budget, our direct labor budget, and our manufacturing overhead budget. So we start with our raw materials budget. We start with that with the last line of our production budget. How many units are we planning to produce? Next, we need our materials requirement per unit. So we'll go back to our information. When we see that we need each finished unit requires 0.5 units of raw materials. So we need 0.5 units of raw materials for each unit that we produce. We take the number of units times our materials requirement, and that tells us how many materials are needed for production in each month. We then need our budgeted ending inventory. So our information tells us that our ending raw materials inventory should be equal to 50% of the next month's materials requirements. Then also tells us that on March 31st, we have inventory of 4,925 units, and our June 30th ending raw materials inventory should be 4,000 units. So we take that information back to our budget. So in June, we want 4,000 units, and in April, we need our May requirements times 50%, because we want 50% of the next month's requirements. And in May, we need 50% of June. We add our desired ending inventory plus the amount we need for production, and we get our total materials requirements for the month. We then deduct beginning inventory. So remember, it told us that on March 31st, we have 4,925 units. Then May 1st, beginning inventory is April 30th's ending inventory. And June's beginning inventory is May's ending inventory. So we subtract that and we get the amount of materials we need to purchase in order to meet our production goals. We then go back to the information and we see that our raw materials cost $20 per unit. So our materials price per unit is $20. We take the amount that we need to purchase times the purchase price of $20, and that tells us how much money we're going to spend on materials each month. Next, we need the direct labor budget. Our direct labor budget starts exactly the same way as the raw materials budget, with our budgeted production units from the production budget. We then need to know how many hours of labor are required per unit and how much we pay for labor. So we go back to our information and we see each unit requires a half an hour of direct labor and cost $15 per hour. So we need a half hour of labor and we pay $15 per hour. We take the number of units we're going to make times the half an hour labor per unit, and that tells us how many labor hours we need to meet our production goals. We then take that times our hourly labor rate to get the cost of direct labor for each month. So now you can see how many pieces are connected as part of our budget. We've already had the sales and marketing department from our sales forecast. Then we've included the production manager who needs to know how to plan for how many pieces we need to produce each month. Then we've included the purchases manager who needs to make sure that we have enough materials on hand. Now we have the HR and scheduling involved. We need to be able to schedule enough people to make sure that we cover how many labor hours we need to meet our production goals. The last manufacturing budget is the factory and overhead budget. If we look at our information, we see that overhead is allocated based on direct labor hours at a predetermined variable overhead rate of $2.70 per direct labor hour. Let's just look at that first before we get to the fixed overhead. So we base it on direct labor hours, which comes from the labor budget. And we have an overhead rate of $2.70 per labor hour. So our budgeted variable overhead is total labor hours times our rate of $2.70 per labor hour. Our fixed overhead is $20,000 a month. And the other important thing to note is that this $20,000 a month is for depreciation. And why it's important to know that is because if you remember from Principles of Accounting 1, when we think about like our statement of cash flows in the chapter that we looked at statement of cash flows in Principles of Accounting 1, how we have to remove depreciation from our cash flows information because depreciation is a non-cash expense. What depreciation shows is usage of our resources, and it's not a cash expense. That is important information because as part of this operating budget, we're going to make a cash budget. And we don't want to include this $20,000 in depreciation as part of our cash expense. So we have $20,000 each month for depreciation. We add those two together and we get our total overhead budget. We have two budget schedules left. Our selling and administrative budgets are what are left. For our selling budget, we start with the budgeted sales. So this is sales dollars instead of sales units. We come up to our sales budget and we get the budgeted total sales dollars for each month. Then we need information about our selling and expenses. So here we find out that sales representatives' commissions are 8% of sales and are paid in the month of sales. Our sales manager's monthly salary is $3,000. So we take that information back to our budget. Our sales commission percent is 8%. We put that in as 0.08. And for formatting, we can change that to a percent. So we take our budgeted sales times our commission rate of 8%, and we get the total amount of our sales commission expense. Our sales salary was $3,000 per month for our sales manager. So our total selling expenses, our commission plus salaries, and now we have our monthly selling expenses. The last budget schedule that we have is the general and administrative expense budget. So our monthly general and administrative expenses include $12,000 in administrative salaries and 0.9% monthly interest on the long-term note payable. Let's start with our $12,000 in salary. So $12,000 per month in salary. Now we need that interest on the long-term note. So for an interest calculation, remember we have amount times rate times time. The rate that is given here is a monthly rate. So that has already taken care of the times time. So now we just need an amount times our monthly rate. So if we go up here to the balance sheet information that we have, we'll find that we have a long-term note of $500,000. So our interest payment is $500,000 times 0.9%. So we take this information, 500,000, and since it's the same for every month, we'll want to lock this cell. So remember that we want that cell to stay constant. So we want to lock it by putting these dollar signs in there. Times our 0.9%. And you should get $4,500. Because we locked that cell, we can copy that information across and it's going to give us the same information. We add those together and now we have our total expenses for general and administrative expenses. On the next video, I'm going to go through the financial portion of the operating budget, which is the cash budget, the budgeted income statement, and the budgeted balance sheet.